Coming up on Business Incorporated. Ghana Eurobond extend gains as IMF is expected to ease financing stress. And Egypt's stock exchange hits a 6-year low as market rout rages. Plus, Zimbabwe sells gold coins to ease US dollar in high demand. Hello and welcome to the program. I'm Ladi Williams. First off, let's take a look at how your money is performing at intraday in Africa. Nigeria's equities market is still in negative territory while it's sustaining the 51,000 level. To close with yesterday, the all-share index shed about 0.21%. In South Africa, it's also negative. Right there, you see the GSE down 1.24%. While the EGX 30 is the only gainer at intraday after hitting a 6-year low. Investors in Egypt, we see activities there led to a 0.11% gain with some buying pressure on the market there. Meanwhile, Kenya's market continued its bullish territory at the close of trade yesterday as the all-share index went up 3.39%. And in the Middle East, there's all the major markets we track there, mostly in negative territory, from Abu Dhabi, where the all-share index shed almost 0.5%, into Dubai. The market had a bigger loss, down over 1%. Saudi Arabia also got hit today, down about 0.18%. And we see Qatar index there, the lone gainer, up 0.37%. Now, heading on to Berlin, Germany has run its first monthly trade deficit in well over a decade. Culprit, more expensive energy imports. Now, observers are wondering if it's a blip in turbulent period or a sign of bigger problems to come. Let's hear more now from Stephen Beardsley right there in Berlin. So, Stephen, break down these numbers for us.
Well, in May, Germany imported goods worth a value of about 127 billion euros. That's about 1 billion euros more than it exported. Now, it's not unusual that export values fall from time to time, but in this case, it's really a story of imports. Those values have been rising relatively steadily since the beginning of the year, and especially in recent months following the war. In this case, we also saw that imports rose again in May while exports fell. Now, trade outside the EU was especially big in this month. 65 billion euros of imports coming from outside the EU in May. Compare that to 58 billion euros of exports. So that's a 7 billion euro deficit just there when you're looking at trade outside of the EU. Again, reason to believe a lot of that is energy as energy prices are rising. Now compare this to last month's trade surplus of 3 billion euros. And then if you look at May 2021, there was a 13.4 billion euro trade surplus. Germany very much accustomed to having a trade surplus in its history. That's why this is so remarkable to see this kind of month.
Quite surprising. So what does this mean? Should Germany be worried about its status as export nation?
Well, there's a couple of things worth noting here. The price of imports, as I said, is rising fast, and that's due mostly to energy costs. Germany has been criticized for being far too dependent on cheap energy as a model or as a basis for its economy in the past. Much of that Russian imports, as we've seen since the beginning of the war, the prices for those resources have risen dramatically, whether it's gas, whether it's oil, whether it's coal. And so not only is it paying more for those Russian resources, but it's also looking beyond Russia to try and find other sources, and it's paying a lot of money for that. It's also worth mentioning here that times do remain turbulent for exporters, and so supply chains are still in disorder, and then also certain markets have been having some problems as well, and both of these areas are covered by China. We're really talking about China, and not only is it a huge market for German exporters, especially when we look at things like automobiles, but it is a massive supplier when we look at parts, not just for automobiles, but for all sorts of machinery. So with China having suffered a lot of these lockdowns in the past few months, that's really eaten into the ability of exporters to get their supplies and to be able to reach one of the world's biggest markets for a lot of their goods. Those two things together can explain a lot of what's going on here.
Quite interesting. But speaking of trade, there are growing expectations that, Joe Biden might lower tariffs against China. How are markets reacting to this?
Well, markets in Asia were definitely buoyed by this today, along with some more positive figures out of China, and that spread to Europe as well. We're seeing a bit more positive sentiment in Europe. The markets there starting out in positive territory. What they're going to have to fight against is, of course, one, these fears of recession that have been lingering now for weeks and are gaining more and more steam, but also they're going to have to, in Germany, they're going to have to compete with concerns over a possible gas shutoff. That's what we talked about yesterday. That is a growing concern in recent days. We saw, for example, that the DAX, Germany's leading index, was one of the only major European indexes to fall yesterday on Monday to lead the week. London and Paris seeing positive gains when they close, but the DAX really sort of stumbling on some of those gas issues. So that's going to be a concern throughout this week, but right now that positive sentiment about Biden potentially setting aside some of these trade tariffs, lowering the price of consumer goods, that does have investors buoyed right now around the world.
Yeah, energy concerns continue to weigh over there. Thank you so much, Stephen Beardsley, right there in Berlin. All right, now let's head on to the UK. We have Juliana standing by right there. Great to have you, Juliana. So the Bank of England has told lenders to prepare for deteriorated economic outlook and predicted that increases in house prices would slow down later this year. How's this being received over there?
Good afternoon, Laddie. Well, I think it's not been received well, because if you have a look at the FTSE All-Share, all of the main fallers are from banks, and that's because the Bank of England have released their latest financial stability report, and they have warned lenders in the UK not to pull back on lending. I think it's pretty clear that when you are in economic turmoil, as global markets are at the moment, lenders want to make sure they've got enough in their coffers, and many of them have started reining back just to make sure that they can get through this pretty turbulent time. But the Bank of England has said, look, we know you've got enough money in your coffers. We've been doing these risks assessments, which they conduct every year. They're supposed to actually conduct one in London in March, but because of the conflict in Ukraine, they decided to push it back to September. But they said that there is enough money in banks for them to continue lending to consumers in the UK. Now, we know that we're really going through the year of the squeeze, as it's been dubbed. Inflation is at a fresh 40-year high of 9.1%, going through the worst cost of living crisis in a generation. And people, believe it or not, need money. But the Bank of England say there's nothing to fear. Keep lending the way you are lending. And really, one of the main reasons why they're saying to do this is because, unfortunately, this cost of living crisis is affecting people on the lowest amount of incomes. And if you are on a low income in the UK, you're very unlikely to have a mortgage. You're also unlikely to have soaring debt. That's usually middle income to higher income consumers. So yes, they're saying to hold your horses, keep lending as you are, because if you stop doing this, then things could get worse, as we know that this economic crisis in the UK is expected to expand. We're expecting Ofgem, the energy regulator, to increase bills yet again, and we're also expecting inflation to reach double digits by the end of the year.
Right, so keep lending. That's the message from the BOE at this time. But according to a survey, UK asset managers are losing more employees to tech companies as the industry struggles to, embrace new technologies. Tell us about this.
Yeah, this is a really interesting study, actually, conducted by a consulting firm, Accenture. They've been speaking to chief executive officers working at the big asset managed funds in this country. And they've said that about 70% of their staff, which is a really high number, are being lost to these kind of fintech firms, these technology companies that embrace hybrid working, embrace new technology. And I think this data, or this result from this survey, does give a kind of picture of of what the UK labour market looks like at the moment. We know that vacancies are at a record high. We've got over 1 million vacancies at the moment, one of the highest on record, because companies are finding it hard to attract high-skilled, high-qualified staff and retain them. I think as well, if you think of how people were working during the pandemic, people are pretty happy working from home. They were embracing this new technology, and there are fears that the city are losing competitive staff because they have a fear of embracing a new working pattern. However, according to the survey conducted by Accenture, a lot of these asset fund managers are still pretty competent. They're confident in the staff that they do have at the moment, and they do believe they can fulfill the role. However, I think it's not just the city that are facing this issue. I think this is being faced across many sectors in the UK. Not an issue now, but it could become an issue if the labour market does start swelling again and we start seeing vacancies hit 1.5 to 2 million, which is predicted by the end of the year.
Quite interesting. And back here, we're losing tech talent to overseas companies. So I guess that's going round. But it's the second day of trading. I know the FTSE is not looking so good.
Yeah.
How are the markets looking over there?
You're right, it's not looking that great, and it's been led by banks. Banks are falling. Barclays, NatWest, Lloyds, all falling by between 1.8 and 2.2% off the back of that release by the Bank of England's Financial Stability Report. At intraday, the all-share is down 0.52%. FTSE 100 down by 0.86%. And the FTSE 250, the domestic market, that's down by 0.66%. The British pound not faring too well too, down by the US dollar by 0.90%, though up on the euro by 0.48%, but at intraday down to against the Japanese yen by 0.66%, Laddie.
I guess these bear market rallies are getting shorter and shorter by the day. Thank you so much, Juliana. All right, now let's head on to Asia. We'll see shares in Asia Pacific mostly rose today as the Reserve Bank of Australia hiked interest rates in line with expectation. South Korea Kospi's increased about 1.8% to close at 2,341 points, and the Kosdaq advanced 3.9% to 750.95 points, while NAVA rose about 3.4%. The Nikkei 225 in Japan gained about 1% to close at 26,423 points, while the Topix index rose 0.5% to 1,879 points. Hong Kong's Hang Seng Index paired earlier gains to rise 0.43% in its final hour of trade. In Australia, the S&P ASX 200 was 0.25% higher at the close at 6,629 points. And in the U.S., stock futures were lower in early trade this morning after the major averages finished another losing week. Stock futures tied to the Dow Jones Industrial Average fell 118 points. The S&P 500 futures also inched lower at 0.44%, while the NASDAQ 100 futures shed about 0.57%. U.S. Treasury Secretary Janet Yellen and China's Vice Premier Liu He held a virtual call yesterday at stateside to discuss macroeconomic issues. The markets finished one of the worst halves in decades. That was on Thursday, and major averages posted their fourth week of losses in 5, despite modest gains during Friday's trading session last week. And Brent prices slipped today, reversing earlier gains as concerns of a possible global recession curtailing fuel demand outweighed supply disruption fears, highlighted by an expected production cut in Norway. Brent crude fell about 38 cents to $113.12 a barrel, while U.S. West Texas Intermediate crude slid about 50 cents to $107.93. There was no settlement for WTI yesterday because of the Independence Day public holiday in the United States. Investors are becoming more concerned about high inflation and potential recession amid high prices of energy. And gold prices were largely unchanged today as investors stayed away due to a softening inflation outlook and impending interest rate hikes from top central banks. Spot gold was flat at $1,809 per ounce as early trade. U.S. gold futures rose 0.5% to $1,809. Gold held under pressure in the past few months as major central banks around the world move to hike interest rates in their attempt to tame runaway inflation. Spot silver, other metals now gained about 0.7% to $20.09 per ounce, while platinum fell 0.3% to $883, and palladium firmed 0.1% to $1,924. All right, after the break, commodities market update is next. Do stay with us. This is Business Incorporated. Welcome back. Now for commodities market update. See, we're looking at canned foods. First one is corned beef. It's a salted, curated brisket of beef and deployed for a multiplicity of purposes. Price of corned beef, about 200 grams, increased by 20% to 900 naira per can from 750 naira in the last 12 months. Let's hear more now from Shea Omidiora, analyst, financial derivatives company. Great to have you, Shea.
Good afternoon. Thank you for having me today.
Yeah, so no surprise, everything is rising at this point. And what do you think are the primary reasons behind this increase in price of corned beef? And what can be done to mitigate further increases in the price of this commodity? Because I don't know if the prices of cows going up.
Okay, yeah, so I mean, we have seen global inflation, just spiral out of control. We are seeing monetary policy, monetary committees all around the world trying to curtail inflation as it spirals, as it goes out of everyone's control. It's no longer transitory, according to the Fed. That it's now something that's here to stay. So in that regard, it's not surprising at all that things like canned food, which we also do not even produce here, is increasing substantially, and we have seen a 20% increase in the last 12 months. We also know for a fact that global supply chains have been under immense pressure with the backlog of demand that is currently now being in the effect of being given all the way to consumers. And around the globe, we are seeing this because of these supply constraints. Prices are going up. Demand is not going down, and it's not cratering anytime soon. So we are seeing the effects of that in the prices of all commodities, and not just corned beef. And of course, we have also seen the currency depreciate substantially in the past 12 months by about 20% to about $615 naira to the dollar in the autonomous market as well. So I mean, all of these things have had a part to play in the increase in prices of corned beef, as we have seen. And of course, in terms of mitigating the price increases, it has to be a structural change, because, I mean, to the extent that supply chains are not automated, for instance, in many parts of the world, then of course that part has to be taken care of, so that, I mean, some of these backlogs can be taken care of pretty quickly, and we won't have to see increases or sharp increases like this in the near future. So infrastructural investment in infrastructure basically has to happen quickly, so that we will have to mitigate against future spikes in prices like this.
All right, but a close substitute, that's sardines. The price of that is actually also going up. And, we see these prices, moving up together. How does this impact other related commodities?
Okay, so I mean, as we know, both sardines and corned beef, it's not something you actually consume by themselves. It has to be consumed with something else. With sardines, for instance, maybe with bread, for instance, or in sandwiches. Same thing with corned beef. Same thing in jollof rice, for instance. So in all these delicacies, it's not so much so that both commodities are drivers of their complement. It's more or less whether or not we want to see these complements, that sardines and corned beef, in their own diets. And to the extent that prices are running out of control for people, it's either they themselves, consumers will have to find alternatives to corned beef and sardines, because I mean we also know the price of sardines have increased substantially in the past year or so. So it's more or less about consumers finding alternatives to their primary diets, to which they add corned beef and sardines, as against the other way around. So that I believe that's the way it's more or less it's going to work.
What do you think is the elastic limit for consumers at this point with these rising prices?
Yes, that's an interesting question. But I mean, ultimately, it's more or less going to be dependent on whether or not what consumers are looking for, the commodities they are particularly interested in, are essential commodities or luxury items. Now, for essential commodities, what we are likely to see, though, is that consumers will either reduce their rations, or they find alternatives or close substitutes to what they are already consuming. For luxury items, then, I mean, altogether, you might see people cutting them out altogether, nothing else at all, which, I mean, it's not a great thing to see, because, I mean, discretionary income are all-time lows. We are seeing job cuts everywhere. So, I mean, all of these things are not great to see, but it's the current reality, and hopefully it changes soon.
And consumers cutting demand will actually, you know, lead to more of that, more of job losses.
Yes, ultimately, because, I mean, with decreasing demand, then it means that sales are at all-time lows, which means companies aren't profitable. How are they able to pay their employees, for instance? And of course, it's all these things are going to have they are going to cascade into a number of other things, which, I mean, really is going to be all-time negative impact on global economies. So hopefully, I mean, we see an end to many of these things we are seeing across the globe: job cuts, decreased spending, because people really can't afford the things they could during the pandemic, when there was a lot of government spending so as to foster and bring the global economy out of recession. So hopefully we see an end to all of these things soon enough.
Right. Save the consumers, save the world. Right. Thank you so much, Cheo, media analyst, financial derivatives company. Thank you so much.
Thank you very much for having me.
All right, now let's look at other stories. We see Ghana's dollar bonds gained for a second day amid investor optimism. The country's decision to seek an international monetary fund program will ease refinancing stress. West African nation's Eurobond, maturing in 2027, rose 1% to 65.82 cents in dollars by early trade. The capital, the highest in more than 6 weeks. The bond had been trading at distressed levels with yields above 20% before Ghana announced last week it will engage the IMF for balance of payments support. The inflation rate rose more than an 18-year high of 27.6% in May. Economy, which grew 5.4% last year, expanded less than expected in the first 3 months of 2022 at 3.3%. And the main index of Egypt's stock exchange, talking about the EGX, hit its lowest level in almost 6 years. The EGX 30 plunged 3.59% to close at 8,685 points, marking its lowest level since late August 2016. EGX 70 index of leading smaller and mid-cap enterprises dived about 2.57% to 1,655 points, while the fixed-weighted index, EGX 30, capped inched down about 3.29% to 10,679 points. In addition, the equal weights index, EGX 50, sank by 3.46% to 1,564 points. Country's stock market incurred around 15.2 billion Egyptian pounds as market capitalization closed at 592.231 billion pounds. And Zimbabwe's central bank plans to sell gold coins to the public from July 25th as a store of value to stabilize the nation's tumbling exchange rate and offer an alternative to the US dollar, which is in high demand at this time. 1 troy ounce gold coins will be called the Mositunya gold coin. The term means smoke that thunders, a reference to Victoria Falls, the world's largest, greatest sheet of falling water, which traverses Zimbabwe and Zambia. Coin forms part of measures to deal with a currency crisis, seen the annual inflation rate jump to 192%. All right, that's it for the stories in Africa, and that's it on the program. Thank you so much for watching. See you again tomorrow. Bye for now.